So, here's the million-dollar question. Have you ever wondered why, when the government twiddles with something called interest rates, it can make or break businesses and households? Well, let's pull back the curtain on this mysterious lever that seems to control so much. How does a change in interest rates really work its magic? Imagine you have a magical lever. This isn't any ordinary lever. This is a super lever that can turn the economy like the hands of a clock. When people talk about moving or raising interest rates, they're talking about adjusting the settings on this lever. And just like how turning up the volume changes your music experience, changing these rates can bring the whole economy into a different orbit. Now, let's break it down. Interest rates are essentially the price of borrowing money. When you go to a bank for a loan, they charge you an interest rate. This is their way of saying, okay, we're going to give you this sum of money now, but you need to pay us back later with extra cash. The higher the interest rate, the more it costs to borrow. And here's the surprising part. When businesses and households can't afford those extra payments, they might cut back on spending. They might delay big purchases or even stop hiring new workers. This ripple effect sends shockwaves through the economy. It's like if everyone suddenly decided to spend less at the mall, stores would feel it, and so would their suppliers and manufacturers. And that's just one side of the coin. On the flip side, when interest rates are low, borrowing becomes cheaper. Businesses can expand, hire more workers, and invest in new projects. Households might decide to buy bigger houses or go on more vacations because financing feels easier. This flood of activity can boost economic growth. So you see, this magical lever is actually a powerful tool that the government uses to steer the economy. By tweaking interest rates, they can encourage spending when times are tough and dampen it down during booms. It's like using a steering wheel to keep your car on the right path. Sometimes pushing harder, sometimes easing off. Now you know, interest rates aren't just some obscure numbers in the financial news. They're the backbone that holds up so much of our economic landscape. All right, let's dive into how interest rates work like the brake pedal in your car. Picture this. When you step on the brake, what happens? Your car slows down, right? That's exactly how interest rates operate in the economy. When a central bank, like the Federal Reserve in the US, raises interest rates, it's essentially pressing the economic brakes. This makes borrowing more expensive. When loans and credit become harder to get, businesses and individuals are less likely to take out those loans for expansion or purchases. So, spending slows down, and that's exactly what a central bank wants when growth is getting too hot. Slowing things down means fewer resources going into the economy. And it's not just about borrowing money. Higher interest rates also affect savings. People tend to save more because they earn more in interest on their deposits. This means there might be less cash circulating in the system, further reducing spending and investment. On the flip side, when a central bank lowers interest rates, it's like releasing the brakes. Borrowing becomes cheaper, making it easier for businesses to invest and expand and consumers to buy homes, cars, or make other big purchases. This leads to more economic activity and growth. Conversely, savings accounts might offer lower returns, encouraging people to spend that money instead of saving. So, just like your car's brake pedal controls the speed and direction of your vehicle, interest rates control the speed and direction of the economy. By adjusting these rates, policymakers can steer the economy towards a balance they believe is best for everyone. So let's dive into how those initial ripples from the central bank can spread across the economy, like throwing a stone in a big pool of water. Imagine you're standing at the edge of that pool. You drop a heavy stone into it. What happens? That stone causes waves that move outward in all directions. Now, think of the central bank as that stone and interest rates as those waves. When a central bank raises interest rates, they're essentially making borrowing more expensive for everyone. It's like lifting the lid on that pool and letting a gust of wind make the water ripple. Banks take this signal and start charging higher rates to their customers. This is because when it's harder for banks to borrow money from each other due to higher interest rates, they pass these costs on to you and me. For businesses, this means loans become more expensive. It's like if your local car dealership suddenly started asking for a bigger down payment or higher monthly payments. Some companies might decide not to expand or invest as much because it's costlier now to take on new projects. Others might cut back on hiring or hold off on big purchases. For consumers, This is akin to borrowing less money overall. Want to buy a house? Or maybe you need a new car? Higher interest rates mean those loans are more expensive too. You'll likely find yourself saving your hard-earned dollars rather than spending them, which can slow down the economy as a whole. And here's the surprising part. These changes don't happen overnight. It takes time for businesses and consumers to adjust their plans and spending habits in response to higher interest rates. The ripples take a while to fully spread across the entire economic landscape. Okay, so we've seen how higher interest rates can hit banks hard. But what about businesses? How do they feel when those interest rates climb? Imagine you're running a small bakery. You borrow money from the bank to buy new ovens and hire more bakers, essentially expanding your business. Now, let's say the central bank decides to raise interest rates. The cost of that borrowed money just went up. Here's how it works. When you take out a loan to expand, what you pay back is based on the interest rate. If that rate goes up, suddenly, those monthly payments are more expensive. It's like if your rent doubled overnight. Pretty painful for any business owner. And here's the surprising part. Many businesses won't just sit there and pay higher costs. They might start cutting back. Maybe they'll delay buying new equipment or hire fewer employees to save money on interest. This is a big deal because when businesses reduce their expansion plans, it affects everyone else. For example, if your bakery doesn't buy new ovens, that means the supplier of those ovens won't have as many sales. And since they might also start laying off workers due to reduced demand for their products, suddenly we see a ripple effect spreading out from you. So, when interest rates go up and businesses tighten their belts, it can slow down economic growth across the board. It's like if everyone decides to spend less money on new things, everything starts moving slower. And that's how higher interest rates can whisper into the ears of every business owner, causing them to adjust their plans and potentially affecting job markets and overall economy growth. Okay, so far we've talked about how interest rate hikes affect businesses. But the truth is, consumers are feeling the pressure too. You might not realize it, but when the central bank raises interest rates, it's like a ripple effect that spreads throughout the economy, hitting us in our wallets. And here's the surprising part. One of the biggest ways this happens is through mortgages and car loans. When rates go up, suddenly those monthly payments get bigger. And for big-ticket items like houses or cars, these increased payments can be a real shock to the system. Let me give you an easy way to think about it. Imagine you're buying a house. Before interest rate hikes, your mortgage payment might have been manageable. But now that rates are higher, suddenly those payments skyrocket. It's like if your monthly bill for something essential just doubled. Wouldn't you cut back on other expenses? That's exactly what consumers do. And this isn't just about mortgages. Car loans work the same way. If you're thinking of buying a new car and financing it, that interest rate hike means higher payments too. Even everyday credit cards get affected. The more expensive borrowing gets, the less likely people are to spend on things they can finance with credit. So why does this matter? Well, when consumers start cutting back on big purchases like houses or cars, businesses feel it. They sell fewer goods and services, which means profits drop, back to those business effects we talked about earlier. It's a cycle that starts at the consumer level and ripples all the way up. In short, interest rate hikes aren't just for business owners. They impact everyone. When rates go up, our spending habits change, and that affects the whole economy. But here's the surprising part. When interest rates are low, that pool of water calms down. Imagine you're at a busy airport. During rush hour, everyone is rushing around like bees in a hive. But what if one day, the airport decides to slow down the conveyor belts and give people more time? Suddenly, things calm down. People can take their time walking between gates, and businesses have more leeway to plan. Now, let's translate this back to our economy. When interest rates are low, it's like slowing down those busy bees at the airport. With lower borrowing costs, businesses feel less pressure to pay off debts quickly, and consumers find it easier to take on new loans or credit cards. This means more spending and investment in the market. And here's the surprising part. This calm can actually start a growth cycle. Just like when you give people time at an airport, they can finish their work before the next flight lands, thus making the whole system more efficient. In the same way, with lower interest rates, businesses are more willing to invest, and consumers have more disposable income to spend. This increased activity can lead to economic growth. It's a bit like reviving a sleepy city. When everyone starts walking around slowly and confidently, shops and restaurants start doing better. New businesses might open up, creating jobs and boosting the local economy. It's not just about saving money. It's about making sure everyone can breathe, plan for the future, and contribute to growth.